Hello and welcome back. It's your Asset Protector, where we multiply income, protect legacies, and build financial freedom. Today's hot topic, the tax-free time bomb in your retirement account. If you want to retire stress-free, wealthy, and with purpose, then this video is for you. Let's dive into it, shall we? And talk about how to plan towards your retirement. Talking point number one. What is the ticking time bomb? That ticking tax time bomb, it refers to retirement accounts like 401ks, traditional IRAs, and TSPs, for example. Those are tax deferred, meaning every dollar that's withdrawn in retirement, meaning after you stop working and you start taking your money, every dollar is taxed as ordinarily tax money, the same as if you were working now, like you're doing now on your full-time job. Except now you're in retirement and there's not a whole lot that you can do. It's too late at this point. This can explode your tax bill later on when you least expect it. Number two, understanding required minimum distribution, RMDs. RMDs kick in at age 73, whether you like it or not, and it is mandatory, meaning you have to start taking your retirement because at a point, Uncle Sam is going to get his. And if you wait too long, you might die, and then he doesn't get his money, so he's going to make sure you get it. So whether you need it or not, you still have to start withdrawing that money out of your account. And the bigger your balances, the bigger RMDs you must take. The bigger RMDs equals bigger tax burdens for you. Why RMDs can push you into a higher tax bracket. Large withdrawals can trigger higher Medicare premiums. Say that again. Large withdrawals can trigger higher Medicare premiums, meaning that you're going to have to pay more towards your Medicare because you have more money. So sometimes having more money, it doesn't necessarily work in your favor, but there are ways to mitigate these circumstances to offset some of the tax burden or at least defer it. This may also impact your Social Security taxation because taxation in Social Security encompasses all of your money, regardless of whether it's coming from income or pension or whatever. All of that money that you got coming in on Social Security, all of it is taxable. You could lose tax credits or deductions. 401ks and IRAs are tax risk that no one talks about anymore. But they are very important because you've been saving your money in this annuity, or you have it in a mutual fund or whatever you have it in. These are things that people don't like to talk about. 401k, which is a mutual fund, but there is a lot of risk to that, especially if you're under 59 and a half. But even when you are beyond 59 and a half, you're still going to pay taxes because why? It's deferred taxes. It's not no taxes. There's a difference. It's deferred taxes. And do you think that taxes is going to go up or down? You think taxes is going to increase and start costing you more? Or do you think taxes are going to be lowered? Well, historically, taxes has always, except back in the 1920s, but taxes has always been on the incline. And you better bet your bottom buck that is going to continue. So that's because you're partnering with the IRS. You are in what's called a qualified vehicle. And like I said, the government, the IRS, Uncle Sam, whatever you want to call them, is going to get their shares. Most retirees pay more taxes in retirement than they expect to pay. Why? Because they haven't set up mitigating factors to offset that money. Rising taxes in the future is going to shrink your nest egg. You have $1 million in your 401k now, but when you go to draw it out, all of a sudden you only have $670,000 in your nest egg. So that's something to think about. Is it wise to take that money, a portion of that money out now, whether it's an employee matched program or not? It doesn't matter. Is it wise to take a portion of that money out now because you're being taxed on lower taxes on less money? Think about it. As you continue working, you're going to put more money into it. So guess what? You're going to have more money in there. You're going to have a higher balance. Now, do you think taxes are going to go down or up in the future? My guess is that historically, history continues to repeat itself. History is going to repeat itself, and now you got more money, higher taxes. Pull a portion of that money out of there now. Go ahead and take that tax hit. Go ahead and take that hit to the head, so that later on, the blow would be a lot less substantial. Okay? Talking point number 5, how to defuse the tax bomb early. I just told you one way. Start tax planning in your 50s. Don't wait to get in your 70s. It's too late at this point. Start tax planning in your 50s so that you can put your money into an asset that's going to grow your money and then give you a better taxable situation. Okay, like for example, consider a Roth conversion while you're in a lower tax bracket. Utilize an index universal life insurance policy for tax-free retirement income. And this is going to pay you tax-free income for the rest of your life. Why? Because it's already pre-taxed. In a 401k, your money hasn't been taxed. So you're going to be taxed on what's coming out. Not what's in there, but what's coming out of your account as you begin to take withdrawals and loans and that type of thing. Talking point number 6, tax diversification is the new asset allocation. Don't put all your eggs in one basket. Don't put all of your retirement money into one basket or one tax-deferred basket. Have a tax-deferred basket. That makes sense because it's going to help to offset. You're not going to go through this world and work and retire and not pay no taxes. If that's what you're thinking, you're in for a rude awakening. So go ahead up front and pay some taxes. Put your money in a vehicle that's going to pay taxes, but then put the majority of your money in a vehicle where you can offset, mitigate, or dodge that tax bullet. Blend taxable, tax-deferred, and tax-free buckets. In other words, 3 buckets. One of them you're going to have to pay taxes on now. One of them you're going to pay it on later. And then another one you're not paying any taxes at all. This gives you flexibility and control over your taxes in retirement, which leads us to talking point number 7. Now that you got all that money together, you need to talk about legacy planning. Legacy planning without leaving a tax burden to your beneficiaries. Heirs, which means your beneficiary, your children, grandchildren, or spouse, or whomever you leave money to, they may face big tax hits by the IRS from inheritance. So convert into a Roth or use an IUL, like I said, life insurance, index universal life insurance, to pass tax-free wealth. Tax-free wealth. Wealth, giving them a gift without taxation. Set up a trust for structured, tax-efficient wealth transfers. So it's less likely that the trust is going to be taxed, or if it is, it's not going to be as taxed as hard as if it were money that's not in a trust. That being said, don't let Uncle Sam be your biggest beneficiary. Let the people that you love be your beneficiary. Because Uncle Sam is waiting to get you. I'm telling you, it's all a trap. So if you're serious about retiring smart and protecting your future, go ahead and schedule a free session, a free strategy session with me. You can visit www.unitedprospera.com. Go on my website, scroll down near to the bottom, click the booking tab, hit my calendar, set it up. I'll reach out to you on that point in time whenever you schedule your own. It's easy. You schedule your own time that you want to meet with me. You need to change that, you can change that. So it's all in there. It gives you flexibility and gives you control. It's your time, it's your money, and you deserve that. So be proactive, not reactive. Your legacy depends on it. I'll see you on the next video. Bye for now.